Dividend investors, bonjour. This is Mikey Hu, founder of Dividend Stocks and passionate investor. Today, welcome to this Dividend Uncut report. We're talking about, is it the time to buy now? Is it the time to put more money in the stock market? If you have been following me on my blog or at DSR, you already know my answer. Today is always the best time to invest. For once, I will make an exception and I'll tell you about it in a few seconds. First, let me tell you about what happened back in 2017. At the end of 2017, I received the value of my pension plan. I quit my job as a private banker, decided to go full-time to work on DSR, and I received over $100,000 as the value of my pension plan. I decided to manage it on my own, and if you remember correctly, at the end of 2017, we were at the peak of the current bull market. So everything was overvalued, there was no money to be made, and I just decided to use DSR tools, build my portfolio, and invest all my money, 50% in US stocks, the other 50 in Canadian stocks, all dividend growth payer, obviously. And just interesting, it went through first market flash crash, I would say, in 2018, where we lost about 20%, right? And then it went back up in 2019. And on March 23rd, 2020, when the market was down roughly like 40%, my portfolio was still up since inception about 8 to 10%. So obviously over 30 months, it's not a huge return, but we're still talking about 3% annualized return over that period, 3 to 4%. Which is not that bad. So after two crashes, the portfolio was still in positive territories. I've never gone under the $100,000 that I received. And all of that because I followed a strong methodology, focused on dividend growers, and it just worked. So when you're thinking about what's the best timing or the worst timing, well, in 2017, pretty much everybody was agreeing that it was the worst timing ever to invest. And yet, the portfolio is still doing better than the money market funds. Now, back to what's happening right now. For the first time, I'd say just wait a little bit, but wait with a plan. So basically, and this plan is quite easy. In my past webinars, a lot of people in March were telling me, well, Mike, what's your thought about the market? How do you think we should approach that if I have like dry powder and I want to invest right now? Well, I told them invest 1/3 of your money right away, and then 1/3 during the earnings season, which is right now, and then another third once we pretty much know what's going on with the virus, which is likely going to happen during summertime. I've also done a few videos about that on top of webinars. So the first third has been already been invested. Now the second portion of your money should be invested right now, but not necessarily today. Just wait until you get the earnings statement from the company. And what you should look at is not numbers. Obviously, numbers will be disgusting for most companies. Don't expect Disney, for example, to report a great quarter. Their parks are closed. Nobody's going to the movies. Obviously, half of their operating income is shut down right now. So you cannot expect good numbers. What you have to look at is COVID-19 updates, CEO comments that will explain you how the pandemic and the economic lockdown affect the current business, what the company is doing right now to make sure that they preserve the business for sure, because this is the thing that is the most crucial right now. So some will cut their dividends, some will stop their buyback shares program, some others will draw from a line of credit or ask for more debts or issue bonds, whatever. You need to understand what's happening inside the business, and then you need to use your brain and realize what's going to happen next once they have taken those measures. And that's the tricky part, right? So don't look at numbers. Don't, like, revenues are going to go down, earnings are going to go down, some dividend will be suspended or cut. A very good example this morning, Invesco announced a dividend cut of 50%. At DSR, it used to be it used to be rated as a buy, mostly because we thought first Invesco is a large player in the asset manager industry. The merger with Oppenheim Fund, we thought it was great because it was opening a whole new world with ETF. There were some synergies to be made out of it, and their portfolio managers are doing very well over time. They are able to beat like most of their peers. So usually they show returns like 60 to 70% of their portfolio beats the average from their peers for the same asset allocation. So they have a pretty good strong record. So we thought, you know what, the stock has been beaten down. Now it's time to enter in a position. But in the light of what we read this morning, we have to change our decision, reverse it, and then say it's a sell, and we're going to get rid of it in one of our portfolio. Across 9 of our portfolios, we had Invesco in one of them. And unfortunately, the investment thesis that we had has been not going so well. The thing is, Invesco right now is seeing more than 20 billions in assets going from active management towards money market funds. So telling you investors don't necessarily trust the market right now, so it will reflect on revenues going forward, because keep in mind, when assets managers are making money, they're making money from active management, right? Active management funds. The money market funds doesn't pay that much. It doesn't pay the investors, but it doesn't pay the asset managers as well. So that was the first thing that we didn't like. The second thing is obviously when you compare with other asset manager in the industry, I compare it to BlackRock, which is one of my personal holding, which a company that I really like because they're the world leaders in ETF. They're the world largest asset manager as well. And when they published their report a week ago, they published a strong quarter. Not necessarily in terms of numbers, but they were saying, you know what, our system Aladdin is helping assets manager and portfolio managers for institutional clients to manage their portfolio. We're making great switches. We see a lot of people going into ETF right now. So we're enjoying our leadership position in there. So all those positive comments, all those great things that are happening within BlackRock, and then when you read about CEO comments from Invesco, you get the total opposite. They're cutting down their expenses, they're cutting down their dividend, and they're pretty much in surviving mode. So yes, the company will survive. It's a great business. But at this time, it has become just a speculative play, and this is not what we do at DSR. So for that reason, I don't think we should invest in Invesco anymore. This is why we get rid of it in our retirement portfolio. And once in a while, we have to be wrong, right? We're investors, as you are. Analysts are wrong from time to time, and this time, well, it hit us, and we have to own it. What is important here is to make sure that you understand what's happening in the quarter. So don't trade before you get the earnings. Once you read it, then you can verify if it matches your investment thesis or not. The key here is to have your buy list built before you read the earnings, and then you go one by one, verify if the investment thesis stands, and then proceed with another roughly a third of your portfolio, a third of your cash right now sitting on the sideline, and invest it. Expect more fluctuation, more fluctuation, more volatility in the upcoming months. This is only normal. We don't know exactly what's going to happen with the market yet. What I know is the more I stay invested, the better my portfolio is diversified. Over the long term, it's going to be a winner. Over the long term, I'm going to achieve my goal and enjoy my retirement. And this is the kind of conviction that you need to have with your portfolio. You need to be convinced that the company that you have right now, they may go through a rough time, but in the end, in 5 years, in 10 years, in 15 years, they will thrive. They will use that recession, they will use that down market to consolidate their position, grab market shares, innovate, find new growth vectors, but they need to give you something like that in their earnings report. The CEO needs to have a vision, and they need to tell you that they're moving forward, not backward. So I hope that it has helped you gaining a little bit of confidence, and now that you're going to enter into earnings season, you're going to look at each of the quarterly report and make sure that you're making the best decision possible. Subscribe to my YouTube channel. Tomorrow we are reviewing Broadcom. It's going to be a very interesting pick here for your portfolio. So you'll get more information on this one tomorrow. And until then, stay invested. Cheers.